Stack Squad, it's your boy Benjamin Stackems here to put the human experience back in money and equip you with the tools to become financially dangerous. I want to talk to you guys about something that you most likely have in your wallet right now: credit card. More specifically, the APR of your credit card. So you're wondering, what's an APR? It's the annual percentage rate. All right. Now, what is that more specifically? It's really, at the end of the day, just the interest rate in which you're paying on your card. All right. I've seen them go as low as 17, right? Low as 17% and as high as 34%. For the most part, though, from what I've seen with people that I worked with, a lot of them around like 23, 24, 25, 26, around that range. So with that, we have to understand there are two types of APR. You have variable interest rates, and then you have fixed interest rates. Most of them are variable. So what's the difference? Well, we're going to find out right here on consumerfinance.gov. It says right here, a fixed rate APR or fixed APR sets an APR that does not fluctuate with changes to an index. What's an index? It's just something that tracks the market, and you're going to see more specifically a little later on in this video. This does not mean that the interest rate will never change, but the issuer generally must notify you before the change occurs, and in most circumstances can apply the higher rate only to purchases in other transactions that you make after you get the notice. So the interest rate is not going to raise until after you get the notice. So anything that you paid for before the notice is going to stay at that interest rate. And then if they apply a higher interest rate, you're not going to pay that until after the notice. So anything before that notice, you're going to stay at that lower interest rate. Anything after that notice, you're going to pay anything higher. A variable rate APR or variable APR changes with the index interest rate, such as the prime rate published in the Wall Street Journal. The cardholder agreement will say how the card's APR can change over time. Okay, so Wall Street Journal has, and we all know people like investors and stuff like that look at that because they want to track the market. All right, again, an index is something that tracks the market. An example of this is the S&P 500, the Standard & Poor 500, which are the top 500 companies here in the U.S., which then track, to a point, the U.S. economy and what's going on with it, okay? So it's these indexes that help determine the interest rate or the APR, whether it's fixed or variable, that you're going to pay on your credit card. So I want to show you guys something. I'm going to do a call to one of my credit card companies that I'm with, associated with, and we're going to talk to them and see what they know. And yeah, let's check it out. Yeah, I'm just calling to just got some information. I'm just learning a little bit and seeing how this works as well. But I noticed reading some stuff about variable APRs. Now, when I have variable, obviously meaning that, things change and everything. So does that mean like, if we have good credit, then we can call in and maybe request a lower interest rate or anything? Like what is that exactly?
Okay, so yeah, you're actually correct. Variable rate meaning that will that changes, depends. But your question, sir, is if you have a good credit, you said, and then you may call in for possibly lower interest rate. How that works? Is that your question?
Yeah, that's my first question, and so I'm sure there's gonna be more because I'm learning about this stuff here. But if we have good credit and that's variable, like, is there a possibility to lower the interest rate because it's variable?
I can definitely have a look if that is actually possible on your Quicksilver card, Mr. Lopez. But may I know what's your other question about this account while I'm checking the answer to your first question?
Yeah, I was gonna say if that wasn't the case, then that we weren't able. If variable APRs didn't mean that we couldn't request lower interest rates and stuff, then what is variable APR and how is that tracked or how is that managed?
Oh, okay, all right. Just bear with me a second here. Just getting more information on the APR that we have on this account. Here we go. So just to make sure, this APR that you're inquiring today, this is both for the purchase and the cash advance, or just the purchase?
Just the purchases. I don't use cash advance.
The purchase. Okay. All right. Got you. Here we go. Let's see. This specific variable rate that you have on your purchases, which is currently 27.71% variable rate. This may change due to changes in the corresponding index variable. These rates are basically based on Bank Rate Monitor or the BRM, Libor or Prime as published monthly in the Wall Street Journal. Although all three rates are updated monthly, some Libor and Prime rates are updated quarterly. In terms of like your question about changing or lower down the APR, we are currently unable to lower your APR upon request. However, there may be ways you can save with your current interest rate. Would you be interested in hearing a few examples?
Oh, by all means. Yeah.
Okay, all right. Now, first, I just want to, this is definitely applicable solutions based on your account history. Now, instead of one payment at the due date, you can make multiple payments across your billing cycle. Of course, paying earlier in your cycle, and if possible, make larger payments. That's definitely helpful. And if you can afford to make more than the minimum payment, like maybe paying the full statement balance and make larger payments to reduce the balance more quickly. So
Okay.
those are some things that will be helpful.
And I noticed you said something about indexes, and then you said Libor, and then I think you said Bank Rate Monitor. I don't know if I heard that right.
Exactly.
Okay, can you explain those?
Bank Rate Monitor. Yeah.
Okay, yeah, can you explain what each of those are?
Yep. Give me a second here.
Mm-hmm.
Give me a sec. I'm just getting.
Yeah, there's no rush, no worries.
And there we go. Okay. Let's start with the prime rate. Now, the prime rate is like the interest rate most U.S. commercial banks charge to their best customer. Now, this rate is usually influenced by the Federal Reserve Board, raising or lowering the interest rate charged by the U.S. federal government on loans to member banks. Now, that's the first one.
Okay, so you said that was prime rate, correct?
Yes, sir. That's the prime rate.
And just to make sure I understand, then, depending on if the Federal Reserve Bank raises or lowers interest rates, then essentially the credit card APR will go up or down based off of that?
Yes, that's exactly correct, sir.
Okay, got it.
Mm-hmm. Now, the Libor, the London interbank offered rate, this is the average of the interbank offered rates in the London market based on quotations from 16 major banks. Now, it is the rate is updated on our accounts on either a monthly or quarterly basis, depending on the account terms. Monthly Libor is determined by the 1 month Libor, and Treasury Libor is the same as the 3 month Libor listed in the Wall Street Journal's Money and Investing section under the heading Money Rates. Most variable rates with uses are actually monthly or quarterly prime rates instead of Libor.
Okay, got it. And then you said the bank.
The last. Yep.
Yeah, I'm sorry. Go ahead.
Sorry. What was the other one? The Bank Rate Monitor.
Mm-hmm.
Give me a sec. I'm just getting that information right here.
Mm-hmm. No worries.
Okay. Give me a sec, sir.
Mm-hmm. Yeah, no worries. No rush.
Just have to make sure that I got here the correct details. Here we go. Here we go. There we go. With the Bank Rate Monitor, this is the interest rate used by the top 20 banks in the nation when lending money to one another. So it is subject to change weekly, and it is listed in the financial section of the Wall Street Journal as money market deposits under consumer savings rate.
Got it. Okay, so then essentially a little bit of the Libor and the BRM, they're based off, you said the Libor was a 16 top banks in the nation, and then the BRM is the 20 banks in the nation.
Yes, that's right.
Okay.
Yes, correct. Yeah.
Got it. And then a lot of this information, like you said, would be within the Wall Street Journal for us to find out on a either weekly, monthly, or quarterly basis or annual basis.
Yes, that's right. That's right. All of them are there.
Got it. Okay. Yeah, I just wanted to call, get this information so I could understand this a little bit more.
Course.
You know.
Yeah, of course. And it's good to, to learn things like this, especially this actually has something to do with the interest rate of your credit card. So it's good that you're actually want to know more about these things.
Yeah, no, I appreciate it. But other than that, that's really all I needed. I just wanted to find that out.
Okay.
I'll probably read more into this and then probably research that. But,
yeah,
I very much
sure,
appreciate you.
No problem. No worries, Mr. Lopez. Anything else that you want me to check in here for you?
That should be it.
Alrighty. Thank you so much for calling in today, sir. Have a lovely day ahead. You take care.
You too. Thank you very much.
Thank you.
Bye. So there you got it, guys. Financial education is just like it is in college, right? So what happens is that you obtain the knowledge for 4 years at a bachelor's degree, 2 years at a master's degree, 2 years at a doctorate, whatever it is that you're going for. And then you come out of that to be able to apply that information in your life because now you're going into the workforce. Well, here, finance, we're all playing. And if you have a credit card, you've chosen to play the credit game. So the more information that you learn, the more you come out into the field to then learn it, Here we're gonna look more into this now, but the more you apply, the more you'll be able to know, right? And this is like us coming out of college, right? We obtain the information and then we come out and apply it or understand how it works so we can make it work for us. All right, so let's go in here. I want to show you guys basically what I have here on my screen so that way we can understand exactly what she said more. All right, there was 3 things she said to look at. All right, prime rate. She said to look at the Libor, all right, LIBOR, and then she said to look at the bank rate monitor. So let's check this out. I went onto the bank statement of the credit card company that I'm with, and all the way at the bottom they have a box that says interest charge calculation. So here's what they say about variable APRs. If you have a letter code displayed next to any of the above APRs, this means they are variable APRs. They may increase or decrease based on one of the following indexes reported in the Wall Street Journal as described below. So if you look, all right, it says prime rate plus margin, 3-month Libor plus margin. All right, and that's then the first one. The second one says prime rate plus margin, 1-month Libor plus margin. Okay, so she mentioned those 2 of those things, prime rate and Libor, right? And the third one was the bank rate monitor. So what I want you to see here right now, okay, I'm going to put it up on the screen, is Libor. Let's look at what that is. So I got it right here on Investopedia. What is the London Interbank Offered Rate? The London Interbank Offered Rate, Libor, is a benchmark interest rate at which major global banks lend to each other in the international interbank market for short-term loans. All right. Then it says Libor, which stands for London Interbank Offered Rate, serves as a globally accepted key benchmark interest rate that indicates borrowing costs between banks. So think about this. Banks are for-profit entities. So now if they're borrowing based off another bank's interest rate, when it comes to businesses, especially for-profit companies, what happens is they pass on this cost to the consumer. Imagine 3% of all your profits, which doesn't sound like a lot, but it can be a lot. I'm just making this number up. But 3% that one person, the bank, has to, or one institution, the bank, has to take up. So now, no matter what, they can't make 100% profits. They're going to make whatever it is minus 3%. Okay? And now they get to play around with the interest rates in which they lend out to other people because they're passing on, again, the cost to you, to us. So with that, they get to maneuver how much they want to make. And because of that, that fluctuates the interest rates in terms of, like in this case, credit cards, since we're on here. They also state here on Investopedia, according to the Federal Reserve and regulators in the UK, Libor will be phased out by June 30th, 2023, and will be replaced by the Secured Overnight Financing Rate, SOFR, SOFR. So what is that? Put it up here on the screen as well for you guys. All right, it states here, it is a benchmark rate for dollar-denominated derivatives and loans that is replacing the Libor. Okay. Little bit further, we're not going to go super deep into this too, but I just want to tell you guys what it says here on Investopedia, okay? So the secured overnight financing rate, or SOFR, is an influential interest rate that banks use to price US dollar denominated derivatives and loans. The daily secured overnight financing rate is based on the transactions in the Treasury repurchase market, where investors offer banks overnight loans backed by their bond assets. So let's look at this again. I want to point something out here too, where it says that the price is based off US dollar denominated derivatives and loans. So let's think about it. Libor, which has to do with London. Well, now if we're coming up to this SOFR, all right, remember SOFR, the secured overnight financing rate. So now they're determining things over from the UK over in London to what's going on here in the US based off bonds that we have here, based off, and that's basically the credit market. All right, so it all has to do with who's lending to who, how much are they lending at, what interest rate and everything, which then dictates this whole market and then dictates what we're going to be paying, and on in this case with the credit cards and all that. So if it goes up, our credit cards are going to follow and the interest rates are going to rise. If it goes down, our credit cards are going to follow and it's going to go down. All right, all APRs here that we got to look at. All right, so the other thing that they mentioned was the prime rate. So what is prime rate? All right, so here, according to Investopedia, the term prime rate refers to the interest rate that commercial banks charge their most credit-worthy customers. When they say credit-worthy customers, they're talking about those who basically got approved for credit cards here. All right, the Federal Reserve, the Fed, sets the federal funds overnight rate, which serves as the basis for the prime rate, which is a starting point for other interest rates. It is the most commonly used benchmark used by banks and other lenders when setting their interest rates for various products, such as credit cards and home loans. Okay, so same exact thing. If that goes up, well, then your credit card APR is going to go up. If it comes down, your credit card APR is going to go down. All right, so it says right here, used by banks and other lenders when setting interest rates for various products, such as credit cards. And then the other thing here, I just want to solidify everything that she said, so that way we're looking it up here. I'm going to put it all up in the screen here for you, okay? All right, so Investopedia says here, okay, it's a bank rate monitor index is what they put it here as. So what is that? The bank rate monitor index is an index of money market interest rates paid on depository accounts at banks and credit unions in the United States. So she mentioned something like that on the call as well. These accounts include checkings, savings, money markets, and CD accounts. So here's the thing about credit. Money is credit. There's no such thing as money. The only thing that exists is credit. Now, when you think about it, money moves. One of the laws is money is that money, it doesn't want to stand still. I'm going to give you an example why. So let's think, a savings account. The average savings account only gives you 0.05% of your money. It's not even 1%. And if you keep it there, it's not really going to do anything. I'd probably get a nickel a year or something like that. But the more you move your money, right? Think about investing. Well, you move your money into a company. That company then uses that money for projects, for tasks, to pay their employees, because then they keep money moving, right? But then those employees come out and use that money to then pay. So money's moving all around here, okay? So now think about it when it comes to banks, because banks hold your money because they actually lend it out. That's a topic for another video. But what happens is that they hold your money, and then you take that money out to then spend it somewhere else. That company then takes that money to spend it somewhere else. That company takes that money to spend it somewhere else. And depending who has it, they may put it in savings account. They may put it in a certificate of deposit. They may put it in savings account, a money market. So at the end of the day, everything is just really based on interest rates, money, period. So we can see how all these indexes come together to then determine what we're going to pay on our credit card, because again, that's a form of money moving itself. So this is something I believe we should start taking more note of and start seeing how things work, because at the end of the day, the more information that we're equipped with, remember, this is a game and there's rules on how this game is supposed to be played. And I mean, just like a video game, there's structure to it. Right? So now this is a structure that we're playing in this video game called finance and really credit. So the more we know, the more we can equip ourselves with the tools to become financially dangerous instead of being in financial danger. Okay, so the more knowledge that we have, I mean, we can conquer the game here. So now that we know Libor, at least for now, because remember, it's going to be phased out in June 30th, 2023. So at the time of this recording, we got 6 months and some change. So we got the Libor, we got the Bank Monitor Index, and then we have the prime rate. So now that we know that we can look at these three things for now, because again, it's going to change in June, part of it, but we can look at these three things right now. And with that, we could kind of see where our interest rates are going to go, up or down on our credit card. And we could adjust our spending habits. We could adjust how we go about using the credit card, you know, even though we should be paying it off every month. Okay. Even though you should be doing that. But either way, if you can't, it'll help you determine what you're going to do with that. Okay, so I just wanted to make sure I got that over to you guys. With that, I'm going to link everything we went over down in the description, okay? I want you guys to go check this out so that way you guys can equip yourselves with the tools to become financially dangerous when it comes to this credit game. And that way you know, again, how you can adjust or what you need to do to adjust when it comes to using your credit card, how to look at interest rates and understand what's going to happen to your credit card and all that, all right? But with that, I'll see you on the next video. Stay financially dangerous, y'all.